Welcome back to the Dividend Diplomats YouTube channel, everyone. You know us by now. Lanny Burt, the Dividend Diplomats. We are going to talk to you today about our top 5 foundation stocks for your portfolio. We're going to bring them back. We're going to discuss them. We're going to talk about their performance update and see, are they beating the market? And are they performing better than our 2 favorite high-yielding dividend ETFs, VYM and SCHD?
Guys, smash the subscribe button. Give this nice video a thumbs up. We're talking about 5 foundational dividend stocks, how they are performing in 2023 amidst all of the volatility from an increase in interest rates, high inflation, the bank crisis, etc., etc. And again, if you guys aren't familiar, definitely check the link to all of it in the description to the top 5 foundation stocks. Those 5 foundation stocks, Bert, what are they first off?
Yeah, the concept came from thinking of like building a house. Like building your portfolio is like building a house from the ground up. We call them a foundation stock because just like your house, you want just steady, reliable foundation that's not going to sink, it's not going to crack. You have to build the structure of your entire dividend portfolio, your entire financial freedom house on top of a solid base. So we found 5 stocks that have weathered storms. They're all dividend aristocrats, and most are dividend kings now. They've been through it. They've increased their dividend through good times and bad. And they may not be the cheapest. They're probably trading at some of them at a slight premium. But the point is, if you're looking to start your dividend investing journey, these are great stocks that you can buy, set, and forget.
Yeah, set it and forget it stocks for the most part. These are stocks that we all know and love or use in our daily, weekly, monthly lives. We're talking McDonald's, ticker symbol MCD, the big golden arches, guys. Everybody loves McDonald's. You can find them on pretty much every corner. The Happy Meals, the Big Macs, you name it, the toy, it's there. They've got it. Procter and Gamble, ticker symbol is PG. All your consumer brands, your toilet paper, your toothpaste, the list goes on with PG. And then you've got Johnson and Johnson, the dividend king, good old reliable J&J, who's now spinning off Kenvue to their consumer part of their company, but a big healthcare pharmaceutical company with J&J. Then you've got your electricity utility supplier Con Ed, good old Thomas Edison. Con Ed, ticker symbol is ED. And then, guys, we're talking about, for those who think young, with Pepsi, ticker symbol PEP. Again, these are the 5 foundation stocks for a dividend stock portfolio.
Right. And in times where we continue to see dividend cuts with your Intels, with your Paramount, companies that were building their long-term investing journey, it's nice to know that you have these 5 reliable companies that you can feel good about in your portfolio. You can sleep at night, and that's really what it's all about. So we're going to compare them. We're just going to run them. We're going to quickly run them through share the metrics in our stock screener. Shows on the PE ratio, payout ratio, dividend growth history, and dividend yield. And then, as you mentioned, Lanny, earlier, we're going to focus on performance too to see how they're doing compared to the S&P 500, VYM, and SCHD over year-to-date, 1 year, and 5-year performance. So let's start with McDonald's with the golden arches. They have increased that dividend for 46 consecutive years. They are almost a dividend king. A dividend king is a company that's increased its dividend for 50 plus years. An aristocrat has increased its dividend for 25 plus years. So McDonald's, a very solid dividend aristocrat that's about to evolve into a dividend king. They're very expensive from a PE perspective. They're 26.94, so they're above the market. Payout ratio, though, is perfect. It's below the 60% threshold. It's a 55% payout ratio. From a dividend growth perspective, great too. Their 5-year dividend growth rate is 8.26%, and their last dividend increase was 7%. And lastly, that yield is only 2%, but they at least make up for it on the dividend growth front.
Exactly, guys. McDonald's, again, can't go wrong. They're a big real estate company, as everybody likes to say, as they franchise out their land to build more McDonald's shops. Internationally, they're just a beast. You've got to love their future outlook, current outlook. because obviously the previous outlook has showed that they can do this time and time again. They're up, again, over 20% in the last year, up almost 12 to 13% this year. 5 year, they're up almost 80%. And that just pretty much crushes everything from the S&P 500 over the last, 4 months, 12 months, 60 months. And then obviously crushes VYM and SCHD as well. There's just no question there.
Yeah, and we'll put instead of reading them out for each of those three, we'll just continue to flash them up next to each other to show how the performance does for them. So you'll see that chart below, you'll see that going forward. So McDonald's crushed it. Let's see how Procter and Gamble's doing. Their PE ratio is 24, so a little bit cheaper than McDonald's. Their payout ratio is also perfect because they got that nice earnings boost in their last earnings release, 58% payout ratio. Their 5-year dividend growth rate is 5.73%, and they announced a 3% dividend increase recently. The big one, though, is they are one of the longest term dividend kings. They've increased that dividend for 69 consecutive years. So obviously one of the GOATs and the founders of the Dividend King Club. And lastly, that yield is 2.45%.
I mean, 5 years, they're up over 100%. This could be actually the best performing foundation stock over the last 5 years, over doubling what the S&P 500 has returned. So guys, let us know in the comments who's owned PG stock over those last 5 years. You've got a couple diplomats here that have owned them during that time frame.
Yeah, we both love them and we love all their brands, much like what you said about McDonald's. Wow, it's everywhere. Procter and Gamble everywhere too. Open up your cabinet, you will see Procter and Gamble stuff somewhere in that house.
Bert, you've got to take foundation stock number 3 and how they are doing right now.
J&J, Johnson and Johnson.
No.
The GOAT, the one of our favorite stocks. I love it. Lanny saying that because we bought over 100 shares each between my wife and I of Johnson and Johnson. We love this company. We loved them before they announced the Kenvue split off. We're gonna love them after. So they're gonna split. Kenvue obviously IPO'd. They're gonna spin off all the consumer brands into that, and they're gonna focus on competing on drug development with the Johnson & Johnson. You're gonna get two companies. Both, they perform very well in each one of their respective sectors. So it's going to be a very exciting time to be a Johnson & Johnson and Kenvue shareholder. From a PE ratio, they're going to be the cheapest of the 5 foundation stocks right now. Their PE ratio is 15 after a tough year, after they continue to work through some of those lawsuits and shake out some of the noise. Payout ratio is phenomenal, though. It's 44.69%. And their 5-year dividend growth rate, 6.11%. We call them old reliable because their dividends are always falling in that range of 6 to 8%, at least from the increase front. Their last increase was slightly below it at 5.3%, but we're going to round it up into there. And the cool thing about J&J right now is their yield is almost 3%. It's 2.96%. And Lanny, how have they been performing?
Guys, I mean, J&J actually could be one of the worst performing foundation stocks here on this list. They're up 26, 27% in the last 5 years, which does beat VYM, doesn't beat SCHD, and does not beat the S&P 500. But they've been down this year and year to date about 9 to 10%. So if you might be catching J&J at a discount. Again, I think everybody's kind of bracing to see what's really going to happen, with the Kenvue spinoff. But hey, they've got, the lawsuits kind of behind them, the talc settlements. So, really curious what J&J will do as a solo pharmaceutical company, guys. But again, like this video if you own good old reliable in your dividend stock portfolio. Time for number 4, though, guys. Let's get on Con Ed. Ticker symbol is ED. Almost another dividend king here at 48 years of growing their dividend, guys. They're trading at almost $100 a share. They're up almost 29% in the last 5 years. So definitely even doing better than J&J, a utility player. The yield is actually better than J&J as well at 3.28%, but they lose out on that dividend growth where, because they're a boring utility player, they increase their dividend about 2.65% every year. The last increase was 2.5%. They're not expensive. They're not cheap. They're kind of right in line with the market at a PE of about 20. Payout ratio is just a little bit higher than what we usually see at 67%, but at a utility company, those are normally high as well.
Yeah, that's exactly right. That's a nice little feature there for Con Ed. Performance wise, year to date up 3%, 1 year 6.61%, the 5 year 28%. So it's an interesting from a performance sector. It's nothing great, nothing bad, but the utilities just keep chugging along. The nice yield, the lower growth, which has been something that we typically see in the sector, has been an interesting ride for Con Ed. Lastly, how about number 5 here? Pepsi, the newest entrant to our foundation stock. They replaced one of our old ones that we used to have on here that we retired and we decommissioned. It's now Pepsi time. So crack open that Pepsi, get the nice. We love them because of the soda. We love them because of the Frito-Lay, and they are one of the best recognized brands in the country. It's Coke and Pepsi. You know it. We've done the battle countless times here on our channel. Let's see how they perform though from here. Valuation wise, their PE ratio is 26. So they are one of the more expensive foundation stocks today. Their payout ratio is a little higher though. It's 69%. So it's slightly above there, but not an overall concerning amount from what we're seeing. Dividend growth though, this is where we love them. They just became a dividend king. They increased that dividend for 50 consecutive years. Their 5 year dividend growth is 7.39%. And the cool thing about Pepsi in 2023, every other company is zagging by announcing lower dividend increases. Pepsi's like, everyone, hold my beer. Wait, they're like, hold my Pepsi. We're going to have announced a 10% dividend increase. So they announced a surprise double-digit banger, which is phenomenal for a company in that sector that's facing so many headwinds from the consumer.
Phenomenal. I mean, guys, their brand strength is just so deep for a company. It's hard to compete and argue why Pepsi can't be a foundation stock. Again, they're kind of tearing the cover off the ball. Plus, they have so much future growth potential internationally. Plus, all these other new segments that keep popping up and growing, such as your sparkling water. They own, buble or bubbly or however you'd like to phrase it. So that's just, an example of a surge in, obviously there's a lot of competition, but there's a lot of market share that's to be had right now. That 5 year performance at almost 100%, up 99%, obviously right there with PG, kind of high fiving each other, dividend kings coming together to unite. Up 13% in the last year, up over 8% year to date. So definitely outperforming all indices, all indexes right now. Just really doing well. Great company. Can't say anything more.
Interestingly, so just to take a step back, we covered the performance of all the foundation stocks. We obviously love them because they're the great buy and hold. You can sleep at night type stocks. That's what it's all about. Interestingly, all three of them, and how three of them, what am I talking about? This is top 5 foundation stocks, not 3. All 5 of them are beating the S&P 500 from a yield perspective, but all but one are beating VYM, and all of them trail SCHD, which are obviously larger ETFs that are focused on higher dividend yields and higher dividend growth. What fascinates me, though, is from the performance perspective, that of 3 of the 5 jump out in the long run of beating the S&P 500, VYM, and SCHD, and that's McDonald's, PG, and Pepsi. So 3 of the 5 just crush the index in those 2 funds right out of the gate. J&J, Consolidated Edison, they're not far behind. Their performances aren't bad. In the short term, they're performing better than some of the funds, trailing the market, but overall, they're still hanging in there. I just think it's fascinating to see when you take a step back and look at the performance of all 5.
They're hanging with the best of them, guys. So how many, though, Bert, do you own right now out of these top 5 foundation stocks? Bert's like,
Right. There it is. Can't see me. What about you, Danny?
Well, we own all 5 as well, between my wife's portfolio and I. And actually, you own everything here because you also own SCHD.
That's right. I run it and I get the S&P 500 through VOO too. So yeah, made for 8 tonight. Take that. So everybody, let us know, what are your thoughts about our top 5 foundation stocks? How many of these 5 companies do you own? What's your takeaway from looking at the performance? Do you buy individual stocks in foundation positions like this? Or do you prefer to just diversify away and buy index funds, VYM, SCHD, or other dividend-focused ETFs? It's going to be interesting to see. And if you haven't already, subscribe to the channel. Give this video a thumbs up. And Lanny, is there anything else you would like to tell the viewers tonight?
Guys, well, first off, keep saving, keep investing, keep reaching financial freedom, but you're either with us or you're against us, guys. That was Bert and Lanny from the Dividend Diplomats. Over and out.